Welcome back. Here's a new update regarding mortgage delinquencies and also foreclosures. It's been about only 1 week since I made my previous video regarding this, but there's actually two new reports I want to share with you guys in today's video, and also some new developments happening right now. So the first report I want to share with you guys is actually ICE's mortgage monitor. This is what was Black Knight. Black Knight was purchased by ICE in September here. So in any case, regarding the national delinquency rate for mortgages, that increased 12 basis points to 3.29% this September. Also up by 13 basis points from 1 year ago. The second and also the largest annual rise in more than 2 years. That sounds bad, right? Now read on here. The population of loans 30 days past due climbed 5.1% this month, or in September, its fourth consecutive rise, while 60-day delinquencies increased for the sixth consecutive month, increasing a gain of 3%. All sounds very bad. However, provide some context here. Despite the rise, the national delinquency rate is still 71 basis points below pre-pandemic levels, or a decrease of 0.71 percentage points, and also down by 126 basis points, or 1.26 percentage points below the same month average from 2000 through 2005, before the great financial crisis. So if you read these two paragraphs right here, it sounds like, you know, the housing market is crashing, delinquencies are on the rise. However, when looking at pre-pandemic levels, we're still way below that. And here's actually a really good chart showing just that. And I know a lot of you guys want a housing market crash, a lot of foreclosures to hit the market because you want to see home prices fall. But I'm going to give it to you straight here and give you my honest opinion and unbiased reporting regarding what's actually happening right now. Anyway, I've been seeing some videos and a lot of misinformation out there regarding how foreclosures are going to increase big time very, very soon because of all these challenges that are happening right now. I'm not saying our housing market is without challenges. We have all-time record lows for housing affordability. We have historically low levels of existing houses for sale, et cetera, et cetera. A lot of challenges right now happening with our U.S. housing market, and more recently, our labor market, which is showing signs of some cracks over the previous 2 weeks here. But again, I want to provide you guys some unbiased reporting regarding what's actually happening right now. Anyways, the national delinquency rate was 3.29%. Again, the average from 2000 through 2005 was at 4.55%. So not only are we much lower compared to the pre-Great Recession average, we're also well below the pre-pandemic level as well, because back in 2019 and 2018, the rate was around 4%. Now we're still below that. One thing I do want to report to you guys, though, is that the stats kind of vary by the loan product. So for example, FHA loans, which require only 3.5% down, and is a very popular loan product for first-time homebuyers, those rates are actually above pre-pandemic levels, about 109 basis points above September of 2019. Compare that to GSE mortgage performance. GSE is government-sponsored enterprises. These are loans that are backed by Fannie Mae and Freddie Mac. A lot of these loans are people who buy houses for at least 5% down. A lot of people put 20% down. But GSE delinquency rates are 36 basis points below pre-pandemic levels and still about 17 basis points above their March record low. So here's a chart showing just that. So GSE is the blue line right here. So right now we're below levels in 2018 and 2019. Not too far off, but not too far off the all-time record lows that was set back in March this year. In contrast, the black line right here are loans or the delinquency rate for FHA loans. So we saw a huge spike, obviously, when we had COVID lockdowns in, April 2020, but has been more or less decreasing. It has been decreasing for Fannie Mae and Freddie Mac loans, for example, and also for VA for more or less. But FHA loans have started increasing as of late. And on top of that, the current levels right now are still higher compared to 2019 through approximately 2017. Okay, let's change gears slightly here and talk about serious delinquencies. This means the homeowner is at least 90 days late on paying their mortgages here. It says while the number of serious delinquencies rose in September, only a gain of 7,000, it was only the second rise in 3 years, with volumes, or the amount of people who are delinquent or serious delinquent, near the lowest levels since 2006. So even though it increased slightly, it's very close to the lowest levels that we saw back in 2006. On top of that, 70% of these people here remain protected from foreclosure by forbearance, bankruptcy, or other loss mitigation. On top of that, in regards to foreclosure starts, those are still about 40% below pre-pandemic levels, while completed foreclosure sales are roughly half what they were back then. Let's also talk about the amount of equity that current homeowners have right now. So after dipping 14% in late 2022 due to last year's correction, mortgage holder equity has rebounded through 2023. So total equity stands at $16.4 trillion this September, within only 2% of last year's all-time record high. Let's also discuss the amount of homeowners who are underwater on their houses. This means they owe more than what their house is actually worth. So as of September this year, 383,000, or only 0.7% of all mortgage holders were underwater on their houses, less than half the share prior to the pandemic and in the early 2000s before the Great Recession. Likewise, the number of borrowers in limited equity positions remains historically low as well, with 1.9 million, or 4.2% of mortgage holders having less than 10% equity in their houses. So Austin, Texas, that is the area in which home prices have decreased the most compared to last year's highs. So Austin, Texas, where home prices, of course, remain off 14% from last year's peak, is the worst position of all markets, with 2.1% of mortgage holders underwater. After that was Las Vegas and Phoenix, Arizona. So let's briefly recap what we learned so far here. So this September, the national delinquency rate is only 3.29%. It has been increasing, but we're still well below pre-pandemic levels and also well below the average from 2000 through 2005. Additionally, when looking at serious delinquencies, this is at least 90 days or more past due. That increase in September, that was the second rise in the past 3 years. Also very close to the lowest levels since the year of 2006. On top of that, 70% of these people are protected from foreclosure by forbearance, bankruptcy, or other loss mitigation. Here's something else I also want to share with you guys as well. Here's a summary here. So overall, the national delinquency rate is at 3.29%. This is not too far off the all-time record lows that was set back in March this year at 2.92%. So we're only off by about 40 basis points from the all-time record lows. Now, when looking at least 90 days or more past due, it's at 1.26%. So excluding August, this is actually the lowest share we've had going back to at least September of 2022. So last month, it was at 1.25%. This month, it increased by what? 1 basis point to 1.26%. The lowest share we've had, excluding last month, in the last 12 months. In addition to that, we're about 30 basis points less than September of 2022, when back then the share was at 1.56%. Here's also a look at late payments and foreclosures going back to the year of 2000. So at the bottom here is the most recent trends we have, which is for September. So for people who are 60 days late on paying their mortgages here, there's 296,000 nationwide. This is a bit concerning because this 60-day late bucket here has been increasing every month ever since April. Time will tell what happened with these people here, because will they become current? In other words, they start paying their payments and get current on their late payments, or will they transition into 90 days plus late? Time will tell. Of course, I'll definitely keep you posted. However, when looking at pre-COVID levels at 296,000, this is the lowest reading since at least the year of 2000. So for example, back in December of 2019, there was just under 378,000 people in this bucket here, compared to 296,000 this month. And every month prior to that, a higher amount of people who are late. In contrast, let's look at 90 days plus late. So these are serious delinquencies here. So the reading right now is at 455,000 right now. With the exception of August, which was at 448,000, this is the lowest amount all year. It's also higher compared to 2019, when at that time it was at 480,000. However, it was lower than any other year before that since 2005. So in other words, excluding 2019, the lowest reading since the year of 2004, when at that time there was 424,000 people in this bucket. Let's also have a look at foreclosures. So for September, there was 214 foreclosures. When looking at pre-pandemic levels though, this is the lowest reading since the year of 2000. Back in 2000, there was 189,000. Now there's 214,000. So relatively low levels of 90 days late, and also foreclosures as well. In regards to the delinquency rate, we're at 3.3%. When looking at 2019 and earlier, pre-COVID levels, 3.3% is the lowest rate since at least the year of 2000, as far back as this data goes. And lastly, here's a report I want to share with you guys as well from ATTOM, or ATTOM is what I'm pronouncing it. They announced this on November 14th for foreclosures for the month of October, which is of course 1 month after Black Knight's report here. So for October, there was about 35,000 US properties with foreclosure filings. That's down 6% from last month, but up 6% from 1 year ago. So foreclosure filings down compared to last month, but up from 1 year ago. When looking at foreclosure starts, lenders started the foreclosure process on 23,000 properties in October. That's down 7% from last month and up 7% from 1 year ago. In regards to REOs, or real estate owned properties, there was 3,332 properties that lenders repossessed in October. That's down less than 1% from last month and down a whopping 20% from 1 year ago. So big picture here, for the month of October, foreclosure filings are down compared to last month. And we're also seeing a decrease of foreclosure starts as well, down 7%. And in addition to that, we're also seeing REOs, or real estate owned properties, also decrease from last month as well. With that said, please leave a comment below your biggest takeaways from today's video. Also, if you guys got any value out of this video whatsoever, then please hit the like button. I appreciate that. Of course, appreciate you. Hope you guys have an awesome day. Like and subscribe, and I'll see you on the next video.